Warren Buffett is considered by many people around the world to be the greatest investor who has ever lived, and that is not just a statement made lightly. His story is one of the most fascinating journeys in the history of finance, and the lessons he has developed over many decades of investing are not just valuable for the wealthy, they are valuable for anyone who wants to build a meaningful financial future. This is a deep walk through one of the most important investment guides ever put together, a guide that explores not just what Warren Buffett does, but why he does it, how he thinks about it, and what the rest of us can learn from his approach. The work at the center of this journey, authored by Robert G. Hagstrom, takes the principles of the Warren Buffett approach and applies them specifically to the way you build and manage a portfolio of investments. Most people who study investing spend a great deal of time thinking about which stocks to buy, and very little time thinking about how many stocks to own, how long to hold them, and how to think about the results. Hagstrom argues, and Buffett's own record powerfully supports, that these questions about the structure of your portfolio are just as important as, and in many ways more important than, simply picking the right individual stock. This is a journey through focus investing, which is the powerful, patient, and mathematically sound strategy that Buffett has used to build one of the greatest fortunes in human history. By the time you reach the end of this journey, you will understand why owning fewer businesses deeply understood is often superior to owning many businesses barely understood. You will understand the mathematics behind why focus investing works, the psychology behind why most people cannot stick to it, and the practical principles you can use to apply it in your own investment decisions. Let us begin. The world of investing is filled with noise, filled with television programs where people shout numbers at each other, filled with websites that update prices every second, filled with fund managers who trade hundreds of times a year, and filled with theories that suggest the only way to be safe is to spread your money across as many different places as possible. Warren Buffett looked at all of this noise and chose a completely different path. He chose simplicity over complexity. He chose concentration over diversification. He chose patience over activity. He chose deep understanding over broad guessing. And the results speak for themselves in a way that no argument or theory can match. Buffett has compounded wealth over many decades at a rate that has turned relatively modest sums of money into billions, and he has done it not by being the smartest person in the room, not by having access to inside information, not by trading furiously every day, but by thinking carefully about a small number of truly great businesses and holding them for very long periods of time. The question that Hagstrom's work asks is a simple but powerful one. If we can understand why Buffett's approach works, and if we can understand the mathematical and psychological foundations that make it superior to most other approaches, can we apply these same principles to build better portfolios for ourselves? The answer the book arrives at is a clear and well-supported yes. But getting there requires understanding several foundational ideas, and we will work through each of them carefully, because each one builds on the last, and together they form a complete and coherent philosophy of investing that is both intellectually sound and practically applicable. The first foundational idea is about the nature of a business, because before you can be an investor in the Buffett tradition, you must first become a student of businesses. Warren Buffett has always said that he thinks of himself not primarily as a stock market participant, but as a business owner. When he buys shares in a company, he is not buying a piece of paper that goes up and down on a screen. He is buying a piece of a real business, a business that employs people, that makes products or provides services, that has customers and competitors, that earns revenues and incurs costs, and that, if it is a good business, generates meaningful amounts of cash year after year. This distinction between thinking like a business owner and thinking like a stock market player is absolutely fundamental, and it is the starting point for everything else that follows in the Buffett philosophy. A stock market player is primarily concerned with price. They want to buy at a low price and sell at a high price, and the most important question they ask is what will the price of this stock do next? A business owner is primarily concerned with value. They want to own a business that generates more and more value over time. And the most important question they ask is, how much will this business earn over the next 5 years, 10 years, 20 years? The stock market player is trading. The business owner is investing. And over long periods of time, investing in genuinely great businesses at reasonable prices produces returns that trading simply cannot match, because the mathematics of compounding work powerfully in favor of the patient investor who allows great businesses to grow their earnings and their intrinsic value year after year. So the first step in building a Buffett-style portfolio is to become a genuine student of businesses, not a watcher of stock prices. You need to be able to look at a business and ask yourself whether it is a business that you would be comfortable owning entirely if you had the resources to do so. If the answer is yes, that is a business worth considering for your portfolio. If the answer is no, or if you are not sure enough to give a confident yes, then no matter how exciting the stock looks on a price chart, it probably does not belong in a concentrated focus portfolio. This sounds simple, and in principle, it is simple, but in practice, it requires a significant shift in the way most people think about investing. Most people have been trained by financial television, by popular investment websites, by the behavior of professional fund managers to think primarily in terms of price movements. They have been trained to look at a stock and ask whether it is going up or going down. They have been trained to react to news events, to earnings announcements, to interest rate decisions, to political developments, by changing their portfolio, by buying or selling based on how these events affect stock prices in the short term. Buffett invites you to think completely differently. He invites you to think about a business the way you would think about a small local business in your community. If you owned a bakery in your town, you would not check the value of your bakery every day. You would not sell your bakery every time there was bad news in the economy. You would think about whether your bakery was making good products, whether your customers were satisfied, whether your costs were under control, whether your revenues were growing, and whether the business was earning a good return on the money you had invested in it. You would measure the health of your bakery in years and decades, not in days and weeks. And you would be patient, knowing that if you ran a genuinely good bakery, well, over time, it would generate significant wealth for you. This is exactly how Buffett thinks about his investments, and it is exactly how you should think about the investments in a focused portfolio. Now, once you have adopted this business owner mentality, the next question is, what makes a business worth owning? And here, Hagstrom draws on Buffett's own statements over many years to lay out the key characteristics that define a truly great business. The first and most important characteristic is what Buffett calls an economic moat. An economic moat is a durable competitive advantage, something that protects the business from competition over long periods of time. Just as a moat around a castle makes it difficult for enemies to attack, an economic moat around a business makes it difficult for competitors to take away its customers and its earnings. Some businesses have wide moats, meaning their competitive advantages are very strong and very durable. Some businesses have narrow moats, meaning they have some competitive advantages, but those advantages are not particularly strong or durable. And some businesses have no moat at all, meaning they are operating in highly competitive industries where any advantage they develop is quickly copied or undercut by competitors. Buffett overwhelmingly prefers to own businesses with wide, durable economic moats. There are several types of economic moats that appear repeatedly in the businesses Buffett has invested in. The first type is the power of a brand. When consumers so strongly associate quality, trust, or desirability with a particular brand name that they are willing to pay more for that brand's products than for alternatives, the brand is functioning as an economic moat. Think about consumer products, companies whose brand names are recognized and trusted all over the world. People do not buy those products because they have carefully analyzed the ingredients and concluded that they are superior to every alternative. They buy them because of the emotional connection they have with the brand, because of the trust they place in it, because of the habit of buying it year after year. That brand loyalty translates directly into pricing power, which is the ability to raise prices over time without losing too many customers. And pricing power is one of the most valuable characteristics a business can have, because it means the business can protect and grow its earnings even when costs are rising. The second type of moat comes from switching costs. Some businesses make themselves so deeply integrated into the operations of their customers that it would be very expensive, time-consuming, or disruptive for those customers to switch to a competitor. Software companies are a classic example of this. Once a company has built its entire operational system around a particular software platform, trained all of its employees on that system, and integrated it with all of its other business processes, the cost and disruption of switching to a different software platform is enormous. This means the software company has significant pricing power over its customers, because the customers know that the cost of switching is so high that they will continue paying even if prices go up somewhat. Buffett has invested in businesses with powerful switching cost advantages, and the durability of these advantages over time generates the kind of predictable, growing earnings that make long-term compounding work so powerfully. The third type of moat comes from network effects. Some businesses become more valuable to each user as more users join the network. A payment network is a good example of this. The more merchants accept a particular payment card, the more valuable that card is to consumers. The more consumers carry a particular payment card, the more valuable it is for merchants to accept it. This self-reinforcing dynamic means that once a payment network achieves a certain scale, it becomes very difficult for a new competitor to break in, because the new competitor's network is much less valuable to both merchants and consumers than the established network. Network effects can create extremely durable competitive advantages, and businesses that benefit from them can generate exceptional returns for their owners over very long periods of time. The fourth type of moat comes from cost advantages. Some businesses have found ways to produce their products or deliver their services at significantly lower costs than their competitors, and this cost advantage allows them to either charge lower prices and attract more customers, or maintain similar prices and earn higher margins, or some combination of both. Cost advantages can come from a variety of sources, including proprietary technology, superior scale, better access to raw materials, or more efficient operational processes. Whatever the source, a durable cost advantage is a genuine economic moat that can protect a business's earnings over long periods of time. Now, the presence of an economic moat is necessary, but not sufficient to make a business worth investing in. There are several other qualities Buffett looks for in a great business. He looks for businesses that are run by excellent managers, people who are not only highly capable operators who can make the business run efficiently, but also people who think like owners, who are honest with shareholders, who allocate capital wisely, and who are focused on building long-term value rather than short-term appearances. Buffett has consistently said that he would rather own a wonderful business run by mediocre management than a mediocre business run by wonderful management. But ideally, he wants both, a wonderful business and wonderful management, and he places enormous importance on the quality and integrity of the management team. He particularly values managers who demonstrate what he calls owner-oriented thinking, meaning they manage the business as though they personally own every share of it, and they are responsible for the long-term outcome. He values managers who communicate honestly with shareholders, who tell the truth about both the good news and the bad news, who set realistic expectations and then meet or exceed them. He values managers who are rational in their capital allocation decisions, meaning they invest the business's earnings in ways that generate the best long-term returns for shareholders, rather than simply expanding the business for the sake of making it bigger. And he is particularly wary of managers who seem more focused on the short-term stock price than on the long-term health of the business. In addition to the quality of the economic moat and the quality of management, Buffett also looks for businesses that require relatively little reinvestment of earnings to sustain and grow their competitive position. A business that earns a lot of money, but then has to spend most of that money on new equipment, new facilities, new technology, or other capital expenditures just to stay competitive, is not nearly as valuable as a business that earns a lot of money and can distribute most of that money to shareholders or reinvest it at high rates of return. The businesses that Buffett has found most attractive over the years tend to be businesses with durable competitive advantages that require limited capital reinvestment to maintain those advantages. These businesses generate what Buffett calls owner earnings, which is roughly equivalent to the cash that the business generates after paying all of its expenses and making whatever capital investments are necessary to maintain its competitive position, but before making any additional growth investments. Owner earnings is Buffett's preferred measure of the true economic earning power of a business, and it is the starting point for his valuation process. Now, we come to the question of valuation, because even the most wonderful business in the world is not worth owning at any price. Buffett's investment approach requires not just finding great businesses, but finding them at prices that represent good value relative to the future earnings those businesses will generate. Buffett's valuation approach is rooted in the concept of intrinsic value, which is the present value of all the cash that a business will generate over its lifetime, discounted back to today at an appropriate rate. This sounds like a complex mathematical formula, and there are indeed mathematical tools that analysts use to estimate intrinsic value, but at its heart, the concept is simple. A business is worth the sum of all the future cash it will generate for its owners, adjusted for the fact that money in the future is worth less than money today, because money today can be invested and earn returns. If you can estimate how much cash a business will generate over the next 10 or 20 years, and you know what rate of return you want to earn on your investment, you can calculate a present value for those future cash flows, and that present value is a reasonable estimate of the business's intrinsic value. The challenge, of course, is that estimating future cash flows is not a precise science. The future is uncertain, and even the best analysts make mistakes in their predictions. Buffett addresses this uncertainty in two ways. First, he focuses on businesses whose future earnings he can predict with relatively high confidence. Businesses with durable economic moats, operating in industries that are not subject to rapid technological disruption. Businesses with consistent historical earnings patterns that give you a reasonable basis for projecting future earnings. Second, he demands what he calls a margin of safety, meaning he only buys a business when its current market price is significantly below his estimate of its intrinsic value. The margin of safety concept was developed by Buffett's mentor, Benjamin Graham, and it is one of the most important principles in the entire history of value investing. If your estimate of a business's intrinsic value is 100 units of currency, and you can buy it for 70 units of currency, you have a margin of safety of 30 units. This margin of safety protects you in two ways. First, if you were wrong about the intrinsic value, and it is actually somewhat less than you thought, you may still have paid a fair price, or even a price that leaves you with some profit, rather than having paid more than the business is worth. Second, if you were right about the intrinsic value, the margin of safety means you will earn not just a fair return on your investment, but an above-average return, because you bought something worth 100 for 70. The combination of investing in businesses with durable competitive advantages and demanding a margin of safety before buying is the core of the value investing approach that Buffett learned from Graham and then adapted and refined over his long career. Now, let us turn to the central innovation of Hagstrom's work, which is the concept of focus investing as a portfolio strategy. Most people who have heard of Buffett know that he looks for great businesses at fair prices and holds them for a long time. But what many people do not fully appreciate is how concentrated his portfolio is, and why that concentration is not reckless, but is actually the mathematically optimal response to a small number of truly great investment opportunities. The conventional wisdom in the investment world is that diversification is the primary tool for managing risk. The more stocks you own, the reasoning goes, the less damage any one stock can do to your overall portfolio if it performs poorly. If you own 100 stocks and one of them goes to zero, you have lost only one part in 100 of your portfolio. If you own 10 stocks and one of them goes to zero, you have lost one part in 10 of your portfolio. Therefore, owning more stocks must be safer. This logic is correct in a narrow and technical sense, but it misses several important points that Buffett understood very early in his career. The first important point is that diversification is a tool for managing uncertainty, not a tool for maximizing returns. If you are genuinely uncertain about the quality of the businesses in your portfolio, if you are not sure which ones are truly great and which ones are mediocre or poor, then diversification makes sense because it ensures that your lack of knowledge about any individual business does not destroy your wealth. But if you have done the hard analytical work to identify a small number of businesses that you understand very deeply and have high confidence in, then spreading your money across many more businesses does not make you safer. It just dilutes the returns from your best ideas. Buffett put this point very plainly when he said that diversification is protection against ignorance, and it makes very little sense for those who know what they are doing. This is a provocative statement, and it is worth thinking carefully about what it means. It does not mean that diversification is always wrong. For most investors who do not have the time or expertise to deeply analyze individual businesses, a broadly diversified, low-cost index fund is probably the best investment strategy available. Buffett himself has recommended this approach for ordinary investors who do not want to invest the time and effort needed to become genuine students of individual businesses. But for investors who are willing to do the work, who are willing to spend significant time and effort understanding individual businesses deeply, and who have the discipline and patience to stick to a concentrated portfolio through the inevitable periods of short-term underperformance, focus investing offers the potential for significantly superior long-term returns. The second important point about diversification is that owning more stocks does not necessarily reduce risk in the most meaningful sense. The risk that diversification is designed to reduce is what financial academics call specific risk or unsystematic risk, which is the risk that any individual business will perform poorly due to factors specific to that business. But there are other kinds of risk that diversification does not protect against at all. There is market risk, which is the risk that the entire stock market will decline, dragging down all stocks regardless of their individual quality. And there is the risk of permanent capital loss, which is the risk that you pay too much for a business and never recover your investment. Buffett is more concerned with the risk of permanent capital loss than with short-term price volatility. He has said many times that in his view, risk is not the volatility of an investment's price, but the probability that the investor will lose purchasing power permanently. And from this perspective, the best protection against risk is not diversification, but deep understanding. If you understand a business deeply enough to be confident that it has a durable competitive advantage, and you are paying a fair or better price for it, then short-term price declines are not risk, they are opportunity. They are an opportunity to buy more of something you know is worth significantly more than its current price. This is why Buffett has famously said that when great businesses go on sale, he gets excited rather than afraid. He is not concerned about short-term price volatility because he knows that the underlying value of the business has not changed just because the stock market has sent the price lower. And if anything, a lower price means he can buy more of a wonderful business at a better price, improving his long-term returns. Now let us look at the mathematics of focus investing more carefully, because this is where Hagstrom makes some of his most compelling and rigorous arguments. The mathematical case for focus investing rests on two related concepts: the law of large numbers and the mathematics of compounding. The law of large numbers tells us that the more observations we have of a truly random process, the closer our results will be to the expected value. If you flip a fair coin 100 times, you will get close to 50 heads and 50 tails. If you flip it 10 times, you might get 7 heads and 3 tails, or 6 heads and 4 tails, or even 8 heads and 2 tails. The more flips, the more reliable your estimate of the true probability. This is the mathematical principle that underlies the case for diversification. If all stocks were equally likely to perform well, and you had no ability to distinguish between good and bad investments, then owning more stocks would give you a more reliable estimate of the market's average return. But here is the key insight, and it is one that most discussions of portfolio theory completely ignore. If you do have genuine analytical skill, if you can identify businesses that have a genuinely higher probability of generating superior returns than average, then concentrating your portfolio in your best ideas will generate higher long-term returns than diversifying into your less compelling ideas. In other words, diversification only makes sense if you cannot tell the difference between good investments and bad ones. If you can tell the difference, and if you are willing to do the work to develop that ability, then concentrating your portfolio in your very best ideas is not reckless. It is mathematically rational. Hagstrom illustrates this point with some powerful simulations and examples that show how a focused portfolio of, say, 8 to 15 stocks, all selected through rigorous fundamental analysis, has historically generated higher returns over long periods of time than a broadly diversified portfolio, despite having higher short-term volatility. The key qualifier is long periods of time. In any given year, a focused portfolio might significantly underperform the market. In a year when the market is rising, your concentrated bets might not rise as fast. In a year when the market is falling, your concentrated bets might fall more sharply than a diversified portfolio. But over periods of 5 years, 10 years, and especially 20 years or more, the mathematics of compounding means that portfolios that earn slightly higher annual returns grow to dramatically larger absolute values. If Portfolio A earns 12 parts in 100 per year, and Portfolio B earns 10 parts in 100 per year, and you invest 1,000 units of currency in each, after 20 years, Portfolio A is worth roughly 9,700 units of currency, while Portfolio B is worth roughly 6,700 units of currency. The difference of 2 parts in 100 per year, compounded over 20 years, produces an additional 3,000 units of currency, which is 3 times the original investment. And if the difference in annual returns is larger, say 4 or 5 parts in 100 per year, the long-term difference in outcomes becomes truly staggering. This is why Buffett has said that a single great insight, a single genuinely exceptional business found at a great price and held for many years, can generate enormous wealth for the patient investor. And it is why he concentrates his portfolio in his very best ideas rather than spreading it across dozens or hundreds of companies. The mathematics also explain why turnover is the enemy of compounding. Every time you sell an investment and buy a new one, you potentially trigger tax obligations on any gains you have realized, and you also reset the compounding clock. The most powerful form of compounding is when you own a business whose value is growing rapidly, and you allow that compounding to continue year after year without interruption. Every time you sell, you give some of your gains to the tax authorities, reducing the amount of capital that continues to compound for you in the future. Buffett's extremely low portfolio turnover, his tendency to hold great businesses for many years or even decades without selling, is not just a reflection of his patient temperament, it is also a mathematically sound strategy for maximizing the after-tax compounding of his wealth. This brings us to the question of what Buffett means when he says his favorite holding period is forever. He does not literally mean that he will never sell anything. He has sold investments when the facts have changed significantly, when the business has lost its competitive advantage, when management has proven to be dishonest or incompetent, or when the price has risen so far above intrinsic value that selling makes sense. But he approaches each investment with the assumption that he might hold it indefinitely, because businesses with genuine durable competitive advantages tend to generate increasing amounts of value over time, and the patient investor who allows this value to compound undisturbed will earn superior long-term returns. The concept of holding forever is also a mental discipline that helps the investor resist the temptation to sell during inevitable periods of short-term price declines. If you have already decided that your holding period is forever, then a decline in the stock price does not trigger any emotional response that leads to selling, because you are not planning to sell anyway. The price decline becomes irrelevant noise in the context of your long-term investment thesis. Now, let us spend some time on the psychological aspects of focus investing, because this is where many otherwise intelligent investors fail. Buffett has acknowledged many times that the psychological challenges of his investment approach are far more difficult to overcome than the intellectual challenges. Understanding what makes a great business and how to value it is difficult, but it is learnable. The truly difficult challenge is maintaining the emotional discipline to stick to your investment convictions during periods when the market is telling you that you are wrong. The stock market is a powerful emotional force. It broadcasts prices continuously, and those prices generate feelings of fear and greed that can overwhelm even the most disciplined analytical thinkers. When the prices of your holdings are rising, it feels good, and the temptation is to buy more. When the prices of your holdings are falling, it feels bad, and the temptation is to sell. But the investor who acts on these emotional impulses, buying after prices have already risen and selling after prices have already fallen, is consistently doing the opposite of what rational investment strategy requires. The rational strategy is to want to buy at low prices and sell at high prices, but the emotional reality is that low prices feel scary and high prices feel exciting, which pushes most investors to do exactly the wrong thing at exactly the wrong time. Buffett has developed what he calls an inner scorecard, by which he means a framework for evaluating his own investment decisions that is not dependent on what the market is doing or what other people think. His inner scorecard asks not how is the stock price performing, but how is the underlying business performing? Is the economic moat still intact? Is management still doing an excellent job of operating the business and allocating capital? Are the earnings continuing to grow in a way that is consistent with the long-term investment thesis? If the answers to these questions are all yes, then a decline in the stock price is irrelevant and may even be an opportunity. Only if the answers to these questions change, only if the fundamental business reality has changed in a negative way, does the rational investor need to reconsider the investment. This inner scorecard requires a high degree of psychological independence. It requires the ability to be comfortable being different from the crowd, to maintain your convictions when the market is telling you that you are wrong, and to resist the powerful social pressure to conform to the prevailing investment consensus. Buffett has said that temperament is more important than intellect in investing, and by this, he means that the ability to control your emotions, to think clearly during periods of market panic or euphoria, and to maintain a long-term perspective when everyone around you is focused on the short term, is more valuable than raw analytical intelligence. There is a fascinating body of psychological research that supports this view, and Hagstrom draws on this research extensively. The field of behavioral finance, pioneered by researchers like Daniel Kahneman and Amos Tversky, has documented numerous systematic biases in human decision-making that lead investors to make consistently poor choices. Among the most important of these biases for investors to understand are several that deserve our full attention, because understanding them is the first step toward managing them. Loss aversion is the tendency for people to feel the pain of losses much more intensely than they feel the pleasure of equivalent gains. Research suggests that losing 1 unit of money is psychologically roughly twice as painful as gaining 1 unit of money is pleasurable. This means that investors are predisposed to do almost anything to avoid realizing losses, including losing investments long after the rational decision would be to sell them, and selling winning investments prematurely to lock in gains and avoid the possibility of losing them. Overconfidence is the tendency for people to overestimate their own knowledge and analytical ability. Most investors believe they are better than average at picking stocks, which by definition cannot be true for everyone. Overconfidence leads investors to take excessive risks, trade too frequently, and underestimate the importance of the margin of safety. Anchoring is the tendency to give too much weight to the first piece of information encountered when making a decision. An investor who bought a stock at a certain price becomes anchored to that price, and this anchor distorts subsequent decisions about whether to buy more, hold, or sell. Confirmation bias is the tendency to seek out information that confirms existing beliefs and to discount or ignore information that contradicts them. This is particularly dangerous for investors who have already committed to a particular investment thesis, because it makes them less likely to update their views when the facts change. Recency bias is the tendency to give too much weight to recent events and too little weight to the longer historical record. After a period of rising stock prices, investors become overly optimistic and expect prices to continue rising. After a period of falling stock prices, investors become overly pessimistic and expect prices to continue falling. Neither expectation is warranted, but both lead to poor investment decisions. The investor who adopts a Buffett-style focus investing approach must work actively to counter these biases. The discipline of only investing in businesses you understand deeply acts as a check against overconfidence. The requirement of a margin of safety protects against the natural tendency to be too optimistic about future earnings. The focus on the inner scorecard rather than the external stock price protects against loss aversion and recency bias. And the commitment to a long holding period protects against the overtrading that behavioral biases tend to produce. None of this is easy. These biases are deeply rooted in human psychology, and no amount of intellectual understanding makes them disappear. But awareness of them is the first step toward managing them, and the disciplines that Buffett has built into his investment approach are specifically designed to counter the most destructive of these biases. Now let us talk about the concept that Buffett calls the circle of competence, because this is absolutely essential to understanding how focus investing works in practice. Buffett has always been very clear that there are many industries and businesses that he simply does not understand well enough to invest in with confidence. For most of his career, he largely avoided investing in technology companies, not because he thought they were necessarily bad businesses, but because he was not confident in his ability to predict which technology companies would have durable competitive advantages over the long term. Technology is a field that changes very rapidly, and competitive advantages that exist today may be completely irrelevant tomorrow if a new technology disrupts the entire industry. Buffett recognizes that his understanding of which technology companies will be dominant 10 or 20 years from now is much less reliable than his understanding of, say, which consumer products companies or financial services companies will be dominant over that same period. He has said that the key to successful investing is not knowing everything about everything, but knowing with great certainty the things you do know, and then only investing in those areas where your knowledge is deep and reliable. This is what he means by the circle of competence. Every investor has a circle of competence, a set of industries, businesses, and types of companies that they understand deeply. Outside that circle is a much larger set of industries and businesses that they do not understand as well. The most important discipline in investing is to stay within your circle of competence and to invest only in businesses where your understanding is deep and reliable. Buffett has said that the size of the circle of competence is much less important than knowing where its boundaries are. A small, well-defined circle of competence is much more valuable than a large but poorly defined one, because it tells you clearly which investments you should consider and which ones you should avoid. The implication of this for building a focused portfolio is important. You should not try to fill your portfolio with a certain number of stocks, regardless of whether you can find that many investments within your circle of competence. If your circle of competence gives you high confidence in only 3 or 4 businesses at a particular point in time, you should own 3 or 4 businesses, not 10 or 15. Having fewer but better understood investments is always preferable to padding your portfolio with investments you understand less well. This patience, this willingness to wait for genuinely great opportunities within your circle of competence and not to force investments just to fill a quota, is one of the most important disciplines of focus investing. Buffett has compared the investment process to a baseball game in which the batter gets an unlimited number of pitches and does not have to swing at any of them. Unlike in real baseball, where the batter has to swing eventually or be called out on strikes, the investor faces no penalty for simply waiting. You can let pitch after pitch go by, watching the market offer you investment after investment that does not quite meet your criteria, waiting patiently for the perfect pitch, a truly exceptional business at a genuinely compelling price, and only then swinging with everything you have. This approach requires extraordinary patience in a world that seems to reward constant activity. Most investors feel compelled to always be doing something, to always be looking for new opportunities, to always be adjusting their portfolio. The Buffett approach asks you to resist this impulse, to be comfortable doing nothing when no great opportunities are available, and to act decisively only when a truly exceptional opportunity presents itself. As Buffett has famously described it, doing very little, yet doing it with great conviction at the exactly right moment, is the cornerstone of his approach. Now, let us turn to the question of how focus investing relates to the broader academic debate about market efficiency. The efficient market hypothesis, developed primarily by Eugene Fama and widely taught in business schools, holds that stock prices already reflect all publicly available information, and therefore it is impossible to consistently earn returns above the market average by analyzing public information. If this theory is correct, then focus investing, and indeed all forms of active stock picking, is a futile exercise. If stock prices always reflect all available information, there is no such thing as an undervalued stock, and the best strategy is to simply own an index fund that captures the market's average return at minimal cost. Buffett has long been a thoughtful and respectful critic of the efficient market hypothesis. He accepts its general logic, which is that most of the time, markets are quite efficient, and it is very difficult to find genuinely mispriced securities. But he rejects its absolute version, which claims that markets are always perfectly efficient and that it is impossible to find mispriced securities. His own investment record is perhaps the most powerful empirical argument against the strong form of the efficient market hypothesis. Over many decades, across many different market environments, in good times and bad, Buffett has consistently earned returns significantly above the market average. The statistical probability of this happening by random chance is extremely small. Buffett attributes his ability to outperform the market to 2 main sources of advantage. The first is his business analysis framework, his ability to assess the quality, durability, and value of a business more accurately than most other market participants. The second is his psychological discipline, his ability to maintain a long-term perspective and resist the emotional reactions that cause most investors to buy high and sell low. Importantly, neither of these advantages comes from access to non-public information. Buffett works entirely with publicly available information, the same information that every other investor has access to. His advantage comes not from knowing things that others do not know, but from thinking about the same information in a more rigorous, more long-term, and more business-focused way than most other investors. This is a crucial point for anyone who aspires to invest like Buffett. You do not need access to insider information. You do not need sophisticated quantitative models. and you do not need to monitor the market every minute of the day. What you need is the discipline to think carefully about businesses, the patience to wait for great opportunities, and the psychological strength to hold your convictions when the market disagrees with you. These things are available to any investor who is willing to do the intellectual and emotional work. Now let us talk about how Buffett actually thinks about portfolio construction, because this is the most practical part of the book, and the part that most directly answers the question of how to build a focused portfolio. The first principle of Buffett's portfolio construction is selectivity. He does not try to own every good business he can find. He concentrates his portfolio in his very best ideas, the businesses where he has the highest confidence in the durability of the competitive advantage, the quality of management, and the attractiveness of the price. Over the years, Buffett has indicated that he thinks a portfolio of 8 to 15 stocks is generally sufficient for an investor who has genuinely done the analytical work to understand each of those businesses deeply. This is a much smaller number than most professional portfolio managers hold, and a tiny fraction of what index funds hold. But the mathematical argument for this level of concentration is compelling. If you own 8 to 15 businesses that you understand deeply and have high confidence in, the diversification benefit of adding additional businesses that you understand less well is very small, while the dilution of your best ideas is very real. The second principle is position sizing, meaning how much of your portfolio you put in each stock. Buffett does not simply divide his portfolio equally among all his holdings. He allocates significantly more capital to his very best ideas, the ones where his confidence is highest and the potential return is greatest. This is a natural consequence of the focus investing philosophy. If you genuinely have more confidence in some ideas than in others, you should invest more in the ones you are most confident about. The third principle is patience after purchase. Once Buffett has bought a stake in a great business at a great price, he is extremely reluctant to sell it, even if the stock price rises significantly. This is because a business that is genuinely growing its intrinsic value over time may appear to become more expensive on a price-to-earnings basis, even as it remains attractively valued on an intrinsic value basis. If a business earns 10 units per share today and is growing its earnings at 15 parts in 100 per year, and you paid 100 units per share for it today, in 5 years, the business will be earning approximately 20 units per share. If the market recognizes the quality of the business and assigns it a higher multiple to reflect that quality, the stock price could be significantly higher than what simple extrapolation of today's multiple would suggest. This is the compounding of intrinsic value that makes great businesses so valuable to hold over long periods of time. The fourth principle is the willingness to hold cash when no great opportunities are available. Buffett has always been comfortable holding significant amounts of cash in his holding company, Berkshire Hathaway, when he cannot find businesses that meet his strict criteria for quality and value. This willingness to hold cash is an important part of the focus investing philosophy because it ensures that when truly great opportunities do appear, you have the capital available to take advantage of them. The investor who is always fully invested, always buying and selling within their portfolio, rarely has the cash available to buy aggressively when a market panic creates genuinely exceptional opportunities. The fifth principle is the evaluation of opportunity cost. Every investment Buffett makes is evaluated not just on its own merits, but relative to the best alternative available. If you are considering buying shares in Company A, the right question is not just whether Company A is a good investment in absolute terms, but whether it is a better investment than every other opportunity currently available to you, including the option of simply holding cash. This opportunity cost framework ensures that your portfolio is always allocated to the genuinely best available opportunities, not just to good enough opportunities that happen to present themselves. Let us now spend some time talking about the role of economic theory and framework in the Buffett approach, because this is an area where Hagstrom's work provides some particularly valuable insights. Buffett is not just a practitioner, he is a thinker, and his investment approach is grounded in a coherent and well-developed economic framework. One of the most important concepts in this framework is the idea that a great business is one that earns a high return on the capital employed in it, and that continues to earn that high return over long periods of time. Return on capital is arguably the most important single metric for evaluating the quality of a business. A business that earns 20 parts in 100 on the capital employed in it is much more valuable than a business that earns only 5 parts in 100 on the capital employed in it, all else being equal. And a business that can sustain a 20 parts in 100 return on capital for many years, because it has a durable economic moat, is more valuable still, because the compounding effect of reinvesting earnings at high rates of return generates extraordinary wealth over time. This is why Buffett focuses so much attention on the economic moat. The economic moat is what allows a business to sustain high returns on capital over long periods of time, despite the natural competitive forces that tend to push returns toward the average. In a perfectly competitive market, high returns on capital attract new entrants who compete away the excess returns until everyone is earning only the cost of capital. An economic moat is what protects a business from this competitive erosion, allowing it to sustain returns significantly above the cost of capital for extended periods. Another important economic concept in Buffett's framework is the idea of the value chain, which is the series of activities through which a business creates value for its customers. Buffett is always asking where in the value chain a business earns its profits and how defensible that position is. A business that earns its profits in the most critical and hardest to replicate part of the value chain is much more valuable than one that earns its profits in a commodity part of the value chain that could easily be replaced by a competitor. Buffett also thinks carefully about the economics of capital allocation, which is the question of how a company deploys the profits it generates. A great business generates more cash than it needs to sustain its competitive position. This excess cash can be deployed in several ways. It can be paid out to shareholders as dividends. It can be used to buy back shares, which reduces the number of shares outstanding and increases the earnings per share for remaining shareholders. It can be reinvested in the existing business to fund growth, or it can be used to acquire other businesses. Buffett believes strongly that capital allocation is one of the most important skills a chief executive can have, and that many otherwise excellent business operators fail to create maximum value for shareholders because they make poor capital allocation decisions. The ideal scenario, in Buffett's view, is a business that generates high returns on capital, has limited need for reinvestment just to maintain its position, generates significant excess cash, and is led by a management team that deploys that excess cash in the most value-creating way available, whether that is dividends, share buybacks, or high-return reinvestment opportunities. When all of these elements come together, the result is a business that compounds shareholder value at exceptional rates over long periods of time, and it is these businesses that form the core of the ideal focus portfolio. Now let us discuss one of the most important and most often misunderstood aspects of the Buffett approach, which is his attitude toward the stock market itself. Buffett views the stock market with a mixture of appreciation and bemusement. He appreciates the stock market because it creates genuine opportunity, specifically the opportunity to buy stakes in great businesses at prices that are sometimes significantly below their intrinsic value. But he is bemused by the market's short-term behavior, by the way prices move up and down dramatically in response to news events, interest rate changes, economic data releases, and the shifting moods of millions of investors. Buffett sees this short-term volatility not as something to fear, but as something to exploit. When the stock market declines sharply, prices go on sale. Great businesses that were fairly valued at higher prices become attractively valued at lower prices. The rational investor should welcome market declines as opportunities to add to positions in businesses they already own and understand, or to initiate positions in businesses they have been watching and waiting to buy at the right price. Buffett has used the metaphor of Mr. Market, originally developed by his mentor, Benjamin Graham, to illustrate this point. Mr. Market is an imaginary business partner who shows up every day and offers to buy your share of the business or sell you his share at a price he sets based on his mood. Sometimes, Mr. Market is exuberantly optimistic and offers to buy your share at a very high price or to sell you his share at an even higher price. Sometimes, Mr. Market is deeply pessimistic and offers to sell you his share at a ridiculously low price. The key insight is that you do not have to accept Mr. Market's offers. You can ignore him entirely most of the time, going about the business of evaluating your businesses on their actual merits and only engaging with Mr. Market when he is offering you a genuinely attractive deal. When he is willing to sell you a stake in a great business at a price significantly below its intrinsic value, you should enthusiastically take that deal. When he is offering to buy your stake at a price significantly above its intrinsic value, you might consider selling. But most of the time, Mr. Market's offers are neither particularly attractive for buying nor particularly attractive for selling, and the rational response is to simply ignore him and focus on the underlying business. This attitude toward the stock market is profoundly liberating for the investor who can genuinely adopt it. It means that market downturns are not events to dread, but events to welcome. It means that you do not need to watch stock prices constantly or react to every piece of economic news. It means that the noise and excitement of the short-term market are largely irrelevant to your long-term investment outcomes. The only thing that matters in the long run is the trajectory of the intrinsic value of the businesses you own. If you are right about that trajectory, if the businesses you own are genuinely compounding their intrinsic value at attractive rates, then the stock market will eventually recognize and reflect that value, and you will earn excellent long-term returns regardless of the short-term volatility. Let us now talk about some specific examples of the types of businesses that exemplify the Buffett criteria, because abstract principles become much more concrete when illustrated with examples. Consumer staples companies are a classic example of the type of business Buffett has historically found most attractive. These are companies that make products that people buy repeatedly, year after year, often driven by strong brand loyalty, with relatively predictable demand and the ability to raise prices over time in line with or above inflation. These companies tend to have durable economic moats in the form of powerful consumer brands, relatively predictable earnings, and limited need for capital reinvestment beyond normal maintenance and brand support. The combination of these characteristics makes them excellent long-term compounders of shareholder value. Financial companies, particularly insurance companies and banks with strong franchises, have also been a major focus for Buffett over the years. Insurance companies are particularly interesting because they receive premium payments up front before they have to pay claims, and they can invest those premiums in the financial markets in the meantime. If the insurance company underwrites its policies intelligently, collecting premiums that more than cover the eventual claims it will have to pay, then the investment portfolio, funded by those premiums, generates returns that effectively cost the insurance company nothing at all. Buffett has called this free float, and it is one of the most attractive structural features of the insurance business model when it is operated well. Media and publishing companies with strong brand franchises have also attracted Buffett's attention over the years, particularly newspapers in their prime, when they had near-monopoly positions in their local markets and could charge advertisers premium rates with minimal competition. The economic characteristics of a local newspaper monopoly in its heyday were attractive from a Buffett perspective: very high returns on capital, significant pricing power, predictable earnings, and limited capital requirements. These companies have since been disrupted by the rise of the Internet, which illustrates the importance of the circle of competence concept. Buffett was invested in newspapers when they were genuine monopolies with strong economic moats. He recognized early that the Internet was likely to erode those moats significantly and adjusted accordingly. This is an example of what Buffett means when he says he is always evaluating whether the economic moat of a business is widening or narrowing over time. The most important ongoing analytical task for the owner of a focused portfolio is not to find new businesses to buy, but to continuously evaluate whether the businesses you already own are maintaining their competitive advantages. If the moat is widening, if the business is becoming stronger relative to its competitors, that is a reason to hold or even add to your position. If the moat is narrowing, if competitive pressures are eroding the business's advantages, that is a signal to be concerned, regardless of what the stock price is doing. The moat is the thing that drives long-term intrinsic value, not the stock price, and the investor who keeps their analytical attention on the moat rather than the stock price will make better long-term decisions. Now, let us turn to the practical question of how an individual investor can apply these principles to build their own focused portfolio. The first step is to spend significant time developing your own circle of competence. Think carefully about what industries and types of businesses you genuinely understand. This might be the industry you work in, where you have deep professional knowledge. It might be industries you have spent years studying as an investor. It might be areas where your educational background gives you particular analytical insight. Whatever the source of your knowledge, be honest with yourself about where your genuine understanding is deep and where it is superficial. The goal is not to pretend to understand things you do not, but to develop deep understanding of the areas where you can develop it, and to stick to those areas. The second step is to develop a research process for evaluating businesses within your circle of competence. This process should start with the competitive advantage analysis. What is the economic moat of this business? How durable is it? And is it widening or narrowing? It should then move to the management analysis. Are the leaders of this business excellent operators and capital allocators? Are they honest and shareholder-oriented? And do they have a track record of making good decisions over time? It should then move to the financial analysis. What is the historical track record of earnings growth, return on capital, and cash generation? And are these trends moving in a positive direction? And finally, it should move to the valuation analysis. What is a reasonable estimate of the intrinsic value of this business? And how does the current market price compare to that intrinsic value? This process takes time and effort, but that investment of time and effort is precisely what creates the analytical edge that makes focus investing potentially superior to index investing. The third step is to build your portfolio gradually and patiently. Do not feel compelled to find 8 to 15 great businesses all at once. If you can find only 2 or 3 businesses that genuinely meet your criteria, start with those and be patient while waiting for more. As you build your analytical capabilities and your understanding of your circle of competence deepens, you will find more opportunities. And remember that holding cash is a legitimate and sometimes optimal portfolio position. The fourth step is to monitor your portfolio with the right focus. Monitor the businesses, not the stock prices. Go through the annual reports and quarterly reports of the companies you own. Track the competitive landscape to see whether the moats are widening or narrowing. Pay attention to management decisions and capital allocation choices, but do not obsessively monitor stock prices because short-term price movements are mostly noise that tells you nothing about the long-term trajectory of intrinsic value. The fifth step, and perhaps the most important, is to maintain the psychological discipline to stick to your investment convictions during inevitable periods of short-term underperformance. Every investor who concentrates their portfolio in a small number of carefully selected businesses will experience periods, sometimes extended periods, when those businesses underperform the overall market. During those periods, you will feel pressure to abandon your approach, to diversify more broadly, to follow the crowd. Resisting that pressure is the most challenging and most important aspect of focus investing. The investors who succeed with focus investing are not necessarily the ones with the deepest analytical skills. They are the ones with the strongest psychological discipline, the ones who can maintain their convictions in the face of short-term adversity and allow their long-term thesis to play out. Buffett has said that he does not need people to agree with him. He needs people to be wrong. What he means by this is that if everyone in the market agrees with his assessment of a business's value, the stock price will already reflect that value, and there will be no opportunity for above-average returns. The opportunities for exceptional returns exist precisely because the market is often wrong in its short-term assessment of a business's long-term value, and the investor who can see past the short-term noise to the long-term fundamentals will be able to exploit those opportunities. But exploiting those opportunities requires the willingness to hold a view that is different from the consensus, sometimes for extended periods of time, and to be comfortable being wrong in the short term in service of being right in the long term. This is why Buffett says that if you are not willing to own a stock for 10 years, you should not own it for 10 minutes. The willingness to hold for 10 years is not just a reflection of patience, it is also a signal that you have genuinely done the analytical work to be confident in your long-term investment thesis, rather than simply speculating about short-term price movements. Now let us talk about how the principles in this approach relate to some of the most important ongoing debates in the investment world. One of the most persistent debates is between active management and passive management. Active managers claim that their research and judgment allow them to select stocks that will outperform the market average. Passive managers argue that the evidence shows most active managers fail to beat the market after fees and transaction costs, and that investors would be better served by simply owning low-cost index funds. The evidence on this debate generally supports the passive side when it comes to the average active manager. Most actively managed funds do indeed fail to beat their benchmark indices over long periods of time, particularly after accounting for their higher fees. But the Buffett approach suggests a more nuanced view. The problem is not with the concept of active management as such, it is with the way most active management is practiced. Most active fund managers run portfolios with hundreds of stocks, turning over their holdings rapidly, trying to predict which sectors and securities will perform best in the short term, and managing their portfolios more to track close to the index than to genuinely maximize long-term returns. This kind of active management adds costs without adding commensurate value, and the passive alternative is almost always superior. But the focus investing approach, with a small number of deeply understood businesses held for very long periods of time with minimal turnover, is a genuinely different animal from conventional active management. The mathematics show that a focus investor who consistently finds businesses with above-average long-term return profiles and holds them patiently over many years can outperform the market significantly, even after accounting for the tax efficiency of low turnover and the absence of the high fees that most active managers charge. The caveat is that this requires genuine analytical skill, genuine patience, and genuine psychological discipline, all of which are rare and difficult to develop. For most investors who do not want to invest the significant time and effort required to develop these capabilities, the passive index fund remains the best practical choice. But for investors who are genuinely committed to developing their analytical capabilities and who have the temperament to practice the patience and discipline that focus investing requires, the approach offers the potential for exceptional long-term results. Another important debate is between growth investing and value investing. Traditional value investors focus on finding stocks that trade at low multiples of current earnings, book value, or cash flow. Traditional growth investors focus on finding companies with rapid earnings growth, often accepting high valuation multiples in exchange for that growth. Buffett has famously said that growth and value are joined at the hip. Growth is always a component of value, and the question is always what price you are paying for what combination of current earnings and future growth. A business with very high current earnings but no growth prospects may be worth a low multiple of current earnings, because all you are buying is the current earnings stream with no expectation of growth. A business with moderate current earnings, but exceptional growth prospects, may be worth a very high multiple of current earnings, because the future earning stream is expected to be dramatically larger than the current one. The Buffett approach does not focus primarily on current earnings multiples or on current growth rates, but on the long-term trajectory of intrinsic value, which incorporates both the current earning power of the business and the expected growth in that earning power over time. This is why Buffett has been willing to pay apparently high multiples for businesses with exceptional growth prospects and durable competitive advantages, while also being willing to buy apparently cheap businesses that are temporarily out of favor with the market. The common thread is not a specific valuation metric, but a rigorous analysis of the relationship between the current stock price and the long-term intrinsic value of the business. Let us now discuss one of the most instructive examples that appears repeatedly in the study of Buffett's investment career, which is his commitment to Coca-Cola. At the time he began making substantial purchases in 1988, Coca-Cola was already one of the most widely recognized brands in the world, with a presence in virtually every country on Earth. Its products were consumed billions of times every day. Its distribution system was extraordinarily difficult to replicate. Its brand commanded extraordinary loyalty among consumers worldwide. And despite all of this, Buffett believed that its stock was trading at a price that significantly undervalued the long-term earnings power of the business, particularly given the substantial runway for growth in international markets that were just beginning to develop consumer preferences for the company's products. He built a large stake in the company, and over the following decade, as international revenues grew rapidly and earnings compounded at attractive rates, the investment became one of the most profitable in his portfolio. This investment illustrates several key principles of the focus investing approach. It illustrates the importance of the economic moat because the brand and distribution network represented one of the most powerful economic moats in all of business. It illustrates the importance of valuation because even a great business needs to be bought at a reasonable price. It illustrates the power of compounding over long holding periods because the really exceptional returns came not from the first few years, but from holding patiently as the business's intrinsic value compounded year after year. And it illustrates the importance of thinking globally about the growth prospects of a business, because a significant part of the investment thesis was the potential for growth in markets outside the United States. Another instructive example is Buffett's long relationship with American Express. He first built a significant stake in American Express in the 1960s during what became known as the salad oil scandal, when a fraudulent company had used American Express warehouse receipts as collateral for loans, and the receipts turned out to be backed by tanks of water rather than the vegetable oil they were supposed to represent. The scandal caused American Express's stock price to fall sharply, as investors feared the company would face enormous liability. But Buffett looked at the underlying business and concluded that the damage was temporary and manageable, and that the core franchise, the American Express brand, and the charge card and traveler's check businesses remained as powerful as ever. He invested heavily, and when the crisis passed and the stock price recovered, he earned very large returns. This investment illustrates the importance of distinguishing between temporary problems and permanent damage to the economic moat. When a business with a durable competitive advantage faces a temporary crisis that causes its stock price to fall sharply, that may be a significant opportunity for the investor who can correctly assess the nature of the crisis. If the crisis is indeed temporary and does not damage the fundamental competitive advantage of the business, then the stock price decline represents a buying opportunity, not a reason to sell or avoid the stock. Only if the crisis is symptomatic of a permanent deterioration in the competitive position of the business should the investor treat it as a negative signal about the long-term investment. Making this distinction correctly is one of the most valuable skills an investor can develop, and it is a skill that requires deep knowledge of the business and its competitive dynamics, which is exactly why the circle of competence concept is so important. Now, let us discuss the role of annual reports and financial statements in the Buffett analytical process, because this is the primary information source that Buffett uses to understand and evaluate businesses. Buffett is a voracious consumer of annual reports and financial filings. He goes through them not just for the financial statements, but for the management discussion and analysis, the letters to shareholders, and any other disclosure that reveals how management thinks about the business and its prospects. He pays particular attention to the honesty and candor of management's communication with shareholders. He has little patience for management teams that present an overly rosy picture of the business, that are reluctant to acknowledge problems, or that use financial engineering to make earnings look better than they truly are. He greatly values management teams that are frank about the challenges the business faces, that acknowledge mistakes and explain what they have learned from them, and that set realistic expectations and then consistently meet or exceed them. In the financial statements, Buffett focuses particular attention on the income statement, the cash flow statement, and the balance sheet, analyzing them together to get a complete picture of the business's financial health and earning power. On the income statement, he focuses on the trend of revenues and earnings over many years, looking for consistent growth and for margins that are stable or expanding. He is particularly interested in the relationship between revenue growth and earnings growth, because a business whose earnings grow faster than its revenues is likely improving its operational efficiency, while a business whose revenues grow faster than its earnings may be facing increasing competitive pressures. On the cash flow statement, he focuses on the generation of owner earnings, the cash the business generates after maintaining and operating the business, which he believes is a more accurate measure of the true economic earning power than reported earnings. He compares capital expenditure requirements to depreciation charges to assess whether the business is maintaining its asset base adequately without overinvesting. On the balance sheet, he pays attention to debt levels and the quality of the assets. He is generally cautious about businesses with high levels of debt, particularly when those businesses face uncertain economic environments, because debt amplifies the consequences of business downturns and can turn a temporary problem into an existential one. He prefers businesses that are self-funding, that generate enough internal cash flow to fund their growth without needing to constantly raise new capital from outside investors. Now, let us turn to a topic that is very important in Hagstrom's work and in the broader Buffett philosophy, which is the concept of business cycles and how the focus investor should think about macroeconomic factors. Buffett is famously dismissive of most macroeconomic forecasting. He has said many times that he pays almost no attention to economic forecasts, interest rate predictions, or political and geopolitical developments when making investment decisions. This is not because he thinks these factors are unimportant, but because he believes they are essentially unpredictable, and that time spent trying to predict them is better spent analyzing businesses. The macroeconomic environment affects all businesses, but great businesses with durable competitive advantages are much more resilient to macroeconomic adversity than average businesses. They can maintain their competitive positions through recessions. They can survive periods of rising interest rates better than heavily indebted companies. They can navigate inflationary environments more successfully because of their pricing power. And when economic conditions improve, they emerge stronger relative to competitors who were damaged by the downturn. This resilience is another reason why the focus investor should focus on quality above all else. A portfolio of truly great businesses will weather economic storms better than a portfolio of average businesses, even if the great business's stock prices also decline in the short term during a market downturn. The critical distinction is between a decline in stock price and a decline in intrinsic value. During a recession or market crash, the stock prices of virtually all businesses fall. But the intrinsic value of great businesses, businesses with durable competitive advantages, continues to compound even through economic downturns because the moat protects the earnings power of the business. Over time, As economic conditions improve and market prices recover, the gap between the intrinsic value that has been compounding and the depressed stock prices will close, generating significant returns for the patient investor who held through the downturn. This is why Buffett has said that he does not worry about recessions and market crashes. He actually welcomes them as opportunities to buy great businesses at even more attractive prices than would normally be available. The investors who sell in panic during market downturns, who allow fear to override their analytical judgment, are doing the opposite of what rational investing requires. They are selling great businesses at depressed prices, often to investors who have maintained their discipline and are able to buy at those depressed prices. The transfer of wealth in the stock market flows consistently from the impatient to the patient, from the fearful to the disciplined, from the short-term oriented to the long-term oriented. This has been true throughout the history of financial markets, and there is every reason to believe it will continue to be true in the future. There is also the important question of inflation and how Buffett thinks about it in the context of investing. Inflation is the gradual rise in the general price level of goods and services over time, and it is one of the most powerful forces that investors must understand and account for in their thinking. Buffett has written and spoken extensively about inflation, and his views on it are deeply integrated into his investment philosophy. He has observed that inflation is particularly damaging to businesses that require large amounts of capital investment just to maintain their current earnings. If a business needs to continuously invest in new equipment, new technology, or expanded facilities just to maintain its existing earning power, then during inflationary periods, the cost of that investment rises, effectively eating into the real returns that the business generates for its owners. On the other hand, businesses with strong pricing power and limited capital reinvestment requirements can actually benefit from moderate inflation because they can raise their prices in line with inflation while their capital costs remain relatively fixed. This is another reason why Buffett places such high value on businesses with strong economic moats and limited capital reinvestment requirements. These businesses not only generate excellent returns in normal times, they also tend to be far more resilient in inflationary environments than businesses that lack these characteristics. For the investor building a focused portfolio, the lesson is clear. Prioritize businesses that have the pricing power to pass through cost increases to customers and that do not need to continuously reinvest large amounts of capital just to maintain their competitive position. These businesses will serve you well across a variety of economic environments, including the inflationary ones. Now, let us talk about when to sell, because this is an area where many investors struggle even more than they struggle with the question of what to buy. Buffett's general principle is that a truly great business should almost never be sold, because the combination of compounding intrinsic value and tax efficiency makes long-term holding almost always superior to selling and reinvesting. However, he has identified several situations where selling is the right decision. The first is when the business's economic moat has been permanently and substantially eroded. If a business that once had a strong competitive advantage has lost that advantage due to competitive disruption, technological change, regulatory change, or some other fundamental shift, then the long-term intrinsic value of the business may be declining rather than growing, and holding it indefinitely no longer makes sense. The challenge here is distinguishing between a temporary setback and a permanent erosion of the moat. Temporary setbacks, even serious ones, generally do not warrant selling. Permanent erosion of the moat generally does warrant selling, even if the stock price has not yet reflected the decline in the business's competitive position. The second situation, where selling may be appropriate, is when the business's management has proven to be dishonest or significantly incompetent. Buffett places enormous value on management integrity, and a management team that has been dishonest with shareholders, or that has made consistently poor capital allocation decisions that have destroyed significant value, is a serious negative that may override even a strong underlying business franchise. The third situation, where selling may be appropriate, is when the stock price rises so dramatically above intrinsic value that the risk-reward calculation tilts decisively against holding. If a business's intrinsic value is 100 units of currency and the stock price rises to 200 units of currency, the expected return from continuing to hold the stock is much lower than the expected return from selling and reinvesting in another business at a more attractive valuation. In this situation, selling and reinvesting makes mathematical sense, even accounting for the tax cost of realizing the gain. But Buffett is careful to note that this situation is less common than most investors assume. Most of the time, when a great business's stock price has risen significantly, the intrinsic value of the business has also risen significantly because the business has been compounding its value, and the stock price rising simply reflects this value creation. The investor who sells simply because the stock price has risen significantly, without carefully evaluating whether the business's intrinsic value has risen by a comparable amount, may be making a mistake. The fourth reason to sell is to redeploy capital into a significantly better opportunity that has become available. If you own a business that is worth fair value or slightly above, and a genuinely exceptional opportunity to buy another business at a significant discount to intrinsic value becomes available, it may make sense to sell the first business and buy the second. But the key word here is significantly better. The transaction costs, both monetary in the form of taxes and psychological in the form of the discipline required to sell a known quantity and buy a lesser-known one, are high enough that the new opportunity needs to be substantially more attractive than the existing holding to justify the switch. This high bar for selling helps prevent the kind of excessive portfolio turnover that is the enemy of long-term compounding. The importance of independent thinking in the investment process cannot be overstated, and it is a theme that weaves through every aspect of the Buffett philosophy. Buffett and his longtime business partner Charlie Munger have both emphasized repeatedly that the ability to think for yourself, to reach conclusions based on your own analysis rather than following the crowd, is perhaps the single most important characteristic of a successful investor. The investment world rewards independent thinking precisely because most investors are not independent thinkers. Most investors follow the herd, buying what is popular and selling what is out of favor, reacting to short-term news and noise rather than focusing on long-term fundamentals. This herd behavior creates the mispricings that the independent thinker can exploit. When a great business is temporarily out of favor with the market for reasons that are superficial or short-term, the independent thinker, who can look past the current pessimism to the long-term earnings power of the business, will buy at depressed prices. When a mediocre business is temporarily in favor with the market because of a fashionable narrative or a streak of good results, the independent thinker, who can see past the current enthusiasm to the absence of a genuine economic moat, will avoid overvalued stocks that the herd is bidding up. Developing this independent thinking capacity requires a strong foundation of analytical knowledge about businesses and competitive dynamics, combined with the psychological strength to hold unconventional views under social and market pressure. It also requires, as both Buffett and Munger have noted, a wide and eclectic base of knowledge that goes beyond just finance and business. Buffett has always been a voracious learner, going through vast quantities of business history, biographies, financial reports, and other material. He has said that going through so much material every day has been the foundation of his analytical capabilities, because the pattern recognition that comes from years of studying businesses across many industries, economic cycles, and competitive situations is what allows him to quickly assess the quality and durability of a new business opportunity. The lesson for the aspiring focus investor is to invest heavily in your own education and knowledge. Go through annual reports and business histories. Study companies in your circle of competence deeply. Learn about the competitive dynamics of industries you find interesting. Study the investment records and thinking of great investors throughout history. And most importantly, think carefully about what you are learning rather than simply accumulating information passively. The goal is to build a mental library of patterns and frameworks that you can apply to new situations as they arise, allowing you to quickly distinguish between genuinely exceptional businesses and merely average ones. Now, let us think about the track record of focus investing as a strategy, not just through Buffett's own record, but through the broader evidence that Hagstrom examines. The historical evidence on concentrated portfolios is compelling. Studies of investment portfolios over long periods of time consistently find that the most concentrated portfolios, those with the fewest holdings, have generated the highest long-term returns, albeit with higher short-term volatility. This is not a paradox when you understand the underlying mechanism. A concentrated portfolio of genuinely great businesses, selected through rigorous fundamental analysis, will capture the full return of those businesses as they compound their intrinsic value over time. A broadly diversified portfolio will capture some fraction of those returns, but also the returns of many average and below average businesses, diluting the overall result. The cost of the higher short-term volatility of a concentrated portfolio is very real because it requires the psychological discipline to hold through periods of significant underperformance. But for investors who can maintain that discipline, the long-term return differential more than compensates for the short-term discomfort. Hagstrom also notes that some of the most successful investment records in history have been achieved by investors running highly concentrated portfolios. Beyond Buffett himself, there are examples of other exceptional investors who have achieved outstanding long-term results through concentrated, high-conviction portfolios. The common threads among these exceptional investors are deep fundamental analysis of individual businesses, long holding periods, high-conviction positions, and extraordinary psychological discipline. None of them achieved their results by knowing more data points about more companies than everyone else. They achieved their results by knowing a small number of things with extremely high certainty and by having the courage and discipline to act on that certainty with sufficient conviction to make a meaningful difference. This brings us back to a theme that runs throughout the entire Buffett philosophy, which is that exceptional investment results require exceptional effort and exceptional discipline, but they do not require access to special information, sophisticated technology, or complex mathematical models. They require a genuine intellectual commitment to understanding businesses, a genuine emotional commitment to the long-term perspective, and a genuine willingness to be different from the crowd. These things are available to any investor who truly wants to develop them. They are not easy, but they are achievable, and the evidence suggests that the investors who develop them will be richly rewarded over time. Now let us bring together all of the major themes we have discussed and synthesize them into a coherent summary of the focus investing philosophy. Focus investing, as articulated in Hagstrom's work and as practiced by Warren Buffett over many decades, is a philosophy built on several interconnected pillars. The first pillar is the business owner mentality, the commitment to thinking about stocks as ownership stakes in real businesses rather than as pieces of paper whose prices go up and down. The second pillar is the circle of competence, the discipline to only invest in businesses that you genuinely understand deeply, and to recognize honestly where your understanding ends. The third pillar is the economic moat, the requirement that the businesses you own have durable competitive advantages that allow them to sustain high returns on capital over long periods of time. The fourth pillar is management quality, the importance of investing in businesses run by honest, capable, shareholder-oriented managers who think like owners and allocate capital wisely. The fifth pillar is valuation discipline, the requirement that you pay a reasonable price relative to intrinsic value, and ideally, a price that provides a meaningful margin of safety. The sixth pillar is concentration, the willingness to put your best analytical work into a small number of high-conviction positions, rather than spreading your capital across dozens or hundreds of investments you understand less deeply. The seventh pillar is patience, the commitment to holding great businesses for long periods of time, allowing the compounding of intrinsic value to work its powerful mathematical magic without interruption. The eighth pillar is psychological discipline, the ability to maintain your long-term investment convictions in the face of short-term market volatility, to resist the emotional impulses that lead most investors to buy high and sell low, and to maintain your inner scorecard rather than being swayed by the market's daily assessment of your performance. When all eight of these pillars are in place, focus investing creates a powerful and self-reinforcing system for generating exceptional long-term investment returns. The depth of understanding created by focusing on a small number of businesses makes you more confident in your investment decisions, which makes it easier to maintain your positions during short-term volatility. The long holding periods maximize the power of compounding and minimize the tax drag of frequent trading. The economic moat criterion ensures that the businesses you own are genuinely great, not just cheap, and that their value is growing over time rather than stagnating. The management quality criterion ensures that the earnings generated by the business are being deployed in the most value-creating way. And the valuation discipline ensures that you are buying at prices that offer the prospect of above-average long-term returns, not prices that assume a perfect future and leave no room for error. The system requires patience because the results tend to manifest themselves over years and decades, not weeks and months. But for investors who can genuinely embrace the long-term perspective, who can genuinely do the analytical work, and who can genuinely maintain the psychological discipline, the focus investing approach offers a path to investment results that few other strategies can match. Buffett has described his investment career as a continuous effort to find outstanding businesses at fair or better prices, to understand those businesses deeply enough to hold them through the inevitable periods of adversity, and to allow the compounding of high-quality businesses to work over long periods of time. There is nothing magical or mysterious about this process. It is fundamentally about doing a small number of things very well, very consistently, over a very long period of time. But in the investment world, as in most other areas of human endeavor, doing the fundamentally important things with great consistency over long periods of time is actually quite rare and quite difficult. Most investors are distracted by the noise of the market, tempted by the apparent excitement of constant activity, seduced by the apparent safety of conventional diversification, and undermined by the emotional biases that make it so difficult to hold to long-term convictions. The investors who overcome these obstacles, who genuinely internalize the focus investing philosophy and apply it with patience and discipline, are the ones who will compound their wealth over long periods of time at rates that most others cannot match. This is the central and enduring message of Buffett's investment career and of Hagstrom's work, and it is a message that has proven its value in the real world of investing over many decades. Let us also spend a moment thinking about the role of learning from mistakes, because no investor, not even Warren Buffett, has a perfect record. Buffett has been remarkably candid over the years in discussing his investment mistakes, and studying those mistakes is just as instructive as studying his successes. One of the most important patterns in Buffett's acknowledged mistakes is the cost of inaction. He has said, on multiple occasions, that some of his most costly errors were not investments he made and lost money on, but investments he did not make because he hesitated or could not bring himself to act with sufficient conviction. This is a striking and important observation. Most discussions of investment mistakes focus on things that went wrong, on businesses that turned out worse than expected, on prices that turned out to be too high. But Buffett emphasizes that the failure to act on genuinely great opportunities when they are clearly available is also a very costly mistake. This is another way in which the focus investing philosophy is demanding. It requires not only the discipline to avoid acting when you should not act, but also the courage to act decisively when you should act. The combination of these two forms of discipline, the discipline of inaction when conditions do not merit action, and the discipline of decisive action when they do, is perhaps the most difficult balance in all of investing. Buffett's discussion of his mistakes also reinforces the importance of the quality-first mentality. Some of his most discussed errors involved buying businesses at what appeared to be reasonable prices, but which turned out to have much weaker competitive positions than he initially assessed. These experiences reinforced his conviction over time that it is far better to pay a fair price for a wonderful business than a wonderful price for a fair business. The high-quality business, even if purchased at a fair rather than a bargain price, will compound its value over time and reward the patient investor. The mediocre business, even if purchased at an apparently cheap price, will tend to disappoint over time as the lack of a genuine competitive advantage becomes more and more apparent in the financial results. Now, let us think about the role that the investment community and the broader financial ecosystem play in creating and perpetuating the conditions that make focus investing possible. One of the most important structural features of the modern investment industry is that it is largely organized around short-term performance measurement. Fund managers are typically evaluated on their performance over 1 year, 3 year, and sometimes 5 year periods. This creates enormous pressure to produce short-term results, which in turn creates a structural bias toward trading and activity rather than toward patient holding of great businesses. A fund manager who owns a genuinely great business that is temporarily out of favor with the market faces significant career risk because the short-term underperformance can lead to client withdrawals and potentially job loss, even if the long-term investment thesis is completely sound. This pressure creates a systematic bias in the professional investment community towards short-term thinking, which in turn creates opportunities for the individual investor who is willing to take a genuinely long-term view. Because most professional investors are forced by the structure of their business to focus on the short term, they create mispricings that the patient, long-term focused individual investor can exploit. When a great business goes through a difficult period that causes short-term underperformance, the pressure that professional investors are under to show good numbers can cause them to sell, driving the stock price below what a rational long-term assessment of the business would justify. This is precisely the kind of opportunity that the focus investor is positioned to exploit. While the professional investors are selling to protect their short-term track record, the focus investor with genuine long-term conviction can buy at prices that will prove to be exceptional value over the following years and decades. This structural dynamic is one of the most powerful arguments for individual investors to adopt the Buffett approach. You have something that most professional investors lack, which is the ability to be genuinely long-term oriented without career risk. You are not subject to quarterly performance reviews. You are not at risk of having your clients withdraw their money if you underperform for a year or two. You can hold your convictions for as long as the fundamental investment thesis remains intact, regardless of what the market is doing in the short term. This freedom from the institutional pressures that constrain professional investors is one of your greatest advantages as an individual investor, and the Buffett approach is specifically designed to exploit it. As we approach the closing thoughts of this journey, there is one more concept that deserves careful attention, and that is the idea of what Hagstrom calls the Warren Buffett Portfolio as a state of mind rather than just a collection of stocks. The truly important thing about the Buffett approach is not the specific businesses he has owned, not the specific prices he has paid, not the specific portfolio weights he has assigned to each position. Those specific decisions are products of their particular historical circumstances and may not be directly replicable by other investors in different times and places. The truly important thing is the way of thinking that underlies those decisions. The business owner mentality, the long-term orientation, the focus on competitive advantages, the demand for management integrity, the requirement of a margin of safety, the willingness to concentrate in your best ideas, the patience to hold for long periods, and the psychological independence to maintain your convictions against the pressure of the crowd. These are all ways of thinking that any investor can adopt and practice. And when you have adopted and internalized these ways of thinking, you have a Buffett-style portfolio, regardless of the specific stocks you hold, because the quality of your decision-making process will produce the kind of long-term results that the Buffett approach promises. The stocks in your portfolio will change over time as new opportunities emerge and old ones mature. But the thinking that guides your decisions can remain constant, continuously improving as you learn from experience, and consistently guiding you toward the kinds of investments that will compound your wealth over the long term. This is ultimately what Hagstrom's work is about. It is not a guide to buying specific stocks. It is a guide to developing the right investment mind, the kind of mind that approaches every investment decision with the discipline, patience, and long-term perspective of Warren Buffett. And the development of that mind is one of the most valuable things any investor can do for their long-term financial well-being. Let us end with a thought about the broader significance of the Buffett approach beyond just investment returns. There is something deeply meaningful about the focus investing philosophy that goes beyond simply making money. It is a philosophy that values substance over appearance, long-term reality over short-term perception, genuine understanding over surface familiarity, and patience over impatience. It is a philosophy that says the world rewards those who take the time to genuinely understand what they are doing, who are willing to be different when the evidence supports it, and who have the discipline to let the results of good decisions compound over time. These are qualities that are valuable not just in investing, but in every area of life. The business owner who takes the time to deeply understand their industry and their competitive position, who focuses on building genuine value rather than simply managing perceptions, who is willing to sacrifice short-term results for long-term health, is applying exactly the same principles that Buffett applies to his portfolio. The professional who takes the time to develop genuine expertise in their field rather than simply accumulating credentials, who builds a reputation on substance rather than appearances, who is patient enough to allow their expertise to compound over time, is doing the same. The Buffett approach is ultimately a philosophy about how to engage with the world thoughtfully, patiently, and effectively. The investment returns are the result, but the principles behind them have much wider application. For the investor who wants to build genuine wealth over a lifetime, the focus investing philosophy offers a clear and well-supported path. It is not a path of quick riches or exciting activity. It is a path of careful analysis, patient holding, continuous learning, and psychological discipline. But it is a path that has been walked by the greatest investor of our time with extraordinary success, and the principles behind it are sound enough that any investor who genuinely embraces them can expect to benefit from doing so. The most important step is the first one, which is to make the fundamental mental shift from thinking like a stock market player to thinking like a business owner. Once you have made that shift, once you genuinely start thinking about the businesses you own rather than the stocks you hold, everything else follows naturally. The search for economic moats, the focus on management quality, the demand for a margin of safety, the willingness to concentrate in your best ideas, the patience to hold for long periods, the psychological discipline to ignore market noise, all of these flow naturally from the business owner mentality. And the business owner mentality itself is simply a commitment to thinking clearly about what you actually own and why, rather than following the crowd or reacting to the daily price fluctuations of the market. Buffett has said that investing is simple but not easy. The principles are indeed simple, and this entire journey through the focus investing philosophy has been an attempt to convey them in the most accessible and clear way possible. But simple is not the same as easy. Implementing these principles requires real effort, real patience, and real psychological strength. The investors who find this approach most valuable will be those who take the time not just to understand the principles intellectually, but to genuinely practice them in their own investment decisions, learning from their successes and their mistakes, refining their analytical skills over time, and building the psychological resilience to maintain their convictions through the inevitable periods of adversity. The journey of becoming a genuine focus investor is a lifelong one, and the most important qualities are not the ones you start with, but the ones you develop through the consistent application of these principles over many years. Start with one business that you genuinely understand and believe in deeply. Study it until you know it better than almost anyone outside the company. Buy it when the price is right. Hold it patiently, and let the principles of focus investing begin to work for you. That is how the journey of building exceptional long-term investment wealth begins, and it is a journey worth taking. The great irony of focus investing is that doing less, owning less, trading less, and thinking more produces more wealth over time than the frenetic activity that most people associate with successful investing. In a world that rewards busyness and activity above almost everything else, Buffett's approach is a powerful reminder that the quality of your thinking and the discipline of your actions matter far more than the quantity of them. Slow down, think deeply, choose carefully, hold patiently, and let the mathematics of compounding do the work that no amount of frantic trading can match. That is the Warren Buffett Portfolio, and it is one of the most powerful frameworks for building lasting financial wealth that the world of investing has ever produced.